everyone. Thank you so much for joining our session today for Accounting and Assurance. This update is part of our not-for-profit speaker series, and we are really happy to be here. If you have participated in some of our other sessions, welcome back. Our audience is very impressive right now. If you have not, we do have a QR code where you can scan and make sure that you are signed up for the rest of the sessions. Go ahead, pull out your phone right now if you'd like to check that. We will also drop a link inside of the chat for you to be able to sign up here soon. With that, let's go ahead and take a look at our learning objectives for today. Our skilled speakers will be coming on very soon to help you recognize the recently issued ASUs. They'll also describe changes that impact elements of financial reporting and review the current FASB project list as well. So let's go ahead and take a look at our speakers. We have Roselle Benoit, Director with Cherry Bekaert, along with Amelia Crawford, Director with our Assurance Services. Ladies, please take it away.
Great, thanks, Maddie, and welcome everybody. Today we've got some great topics in store. We can go ahead and move to the next slide. So I always think it's great to kind of look at where we've been and as we're looking at an A&A update and the changes coming through the pipeline. So these are the past ASUs that have been implemented in recent years, and those dates you're seeing are the dates the ASUs came out, or those standard updates came out, and they got implemented a couple of years after that typically. But you can see we've had a lot of impact to the financial statements lately for nonprofit organizations, from revenue, leases, clarification of presentation and guidance. And so there's been a lot of changes. So this year we've got a few more pieces coming down as far as impact to the organization. So it'll be great to go through those. So to kind of kick things off, I think we've got a polling question to start. So what areas of financial reporting for not-for-profit institutions are in need of enhancement? So could we, get a management discussion and analysis added, an overhaul of the cash flow statement, some additional disclosures surrounding those ESG requirements? Or do you think everything's great and no changes are needed? So we'll give everybody a minute to respond. Please be sure that you're answering the polls in order to get your CPE credit today.
Amelia, I think don't change anything is going to be a very good response.
I have a feeling nobody's going to volunteer for additional changes. So we'll give everybody another couple seconds in order to get the responses in. And Maddie and Eunice will let you guys close that out when needed. There we go. Oh, wow. I'm surprised.
Yeah, not as popular as I thought it would be.
Yeah. All right. So 40% don't change anything. That's about what we expected. All right. So kicking it off today is going to be the standard update that you've probably heard about so far. And that's your ASU 2016-13. You can see the full name of the standard update here, but we'll kind of move into the next slide and talk through some general information. So one thing I wanted to point out, I kind of referred to the standard in many different ways here, just because there is different ways you'll hear people talk about it. So this is Accounting Standard Update 2016-13. It's codified into the codification at 326 or topic 326, so you could hear that reference as well. And then it's commonly referred to as the CECL standard, which is related to the current expected credit loss model that the standard has established. So that's going to be a new model in order to evaluate credit losses, where we're going to look at having an immediate recognition of those estimated expected credit losses over the lifetime of a financial instrument. And management has to make an estimate of what that credit loss estimate would be, as far as looking at historical considerations, and then also factoring current environment and any future considerations and events as well. It is effective for fiscal years that begin after December 15th, 2022. So if you're a 12/31/23 organization, you should have implemented it with this year's audit. If you are a 6/30 organization, you'll be picking up that implementation with your 6/30/24 year end. So in order to get a good understanding of what the standard is changing, a great way is to kind of look at where we were before and what's causing the change in the standard. So under previous GAAP, we followed what was called an incurred loss methodology. And really what that means is that your recognition was being delayed until it was probable that a loss had been incurred. And so it had that probable threshold, and it was based on, that there's historical losses essentially. So very backwards facing. What happened was the global financial crisis really underscored the need for organizations to be estimating what those also current and future considerations might be related to credit losses, and not wait for that probable threshold to be applicable. So when we had that crisis, the FASB and the IASB kind of did a joint commission together to look at, the reporting and what was kind of missing. And this was the recommendation that came out of it. That was, everything was very backwards looking, historical based, waiting for that probable threshold. And it caused your accounts receivable to not have the full true credit loss estimate associated with it. So looking at an overview of ASC 326 or topic 326, it's really intended to improve that financial reporting by getting to an earlier recognition of credit losses. And that'll be for those financial instruments. So you might think of like loans or trade receivables, things like that. We're going to replace that incurred loss methodology that was used previously. So we're not waiting for that probable threshold. And instead, we're moving to that current and expected credit loss model, where you're looking at the lifetime expected credit losses for a financial instrument. So because of that change, because we're not looking only historical, we're looking at current and future considerations, it is expected that you're likely to see an increase in how much allowance that you have recorded. I wanted to also mention a few terms that you're going to see in the slides and in the content. These are the definitions out of the standard. They're pretty wordy, but I wanted to make sure you had that information. It's just kind of defining what is a financial asset, and then also looking at what is amortized cost basis. So you can see the definition of a financial asset, and then that amortized cost basis is really when you have those assets that are adjusted for those bullet points that you see on the screen. So if there was a premium or discount, any kind of write-offs or collection of cash, things like that, that's where you're going to be in that amortized cost basis category. So looking at the old versus the new model, so our previous incurred loss model, that's when, as a reminder, losses were going to be recorded when they were probable of being incurred. And if you had no indication of loss, then you had no reserve required. It was also based on purely historical experience. And then finally, it was common for it to be applied to just those past due receivables. So instead of looking at a receivable balance in its entirety, it was common to look at those that are maybe over 60 days or in that old category when management was considering any kind of allowance that would have been necessary. When we flip to the new expected loss model, that's really where we're going to see that threshold is removed. So that probable threshold to overcome is no longer applicable. Allowances are going to be required, even if it's a remote possibility, then you still have some kind of allowance recorded. And we want to base that future consideration on reasonable and supportable forecasts when we're looking at credit losses. And that's going to be looked at in addition to those current and historical data that the organization has. And then finally, we're applying it to all balances. So whereas before you may have only looked at those old balances, Now, under the new standard, you're including the balance in its entirety. So if we're thinking of trade receivables, for example, you no longer scope out those balances that are maybe 0 to 30 days or 0 to 60. The standard is really saying that, just because something was a recent receivable doesn't mean that you don't have a risk for a potential loss over the lifetime of that receivable. And so because of that, it's part of the entire consideration or calculation under the new standard. So a little bit of an adjustment. Really, it's kind of building on where we were before and then getting rid of that probable threshold that you used to have. When we're looking at transition and how you should apply it at your organization, it is getting implemented using what's called a modified retrospective approach. And what that basically means is that you're going to analyze that cumulative effect of the standard. However, you're not going to go into your past periods and apply it to those balances. You're going to apply it at the opening date of your current period. So we're going to calculate, what was it as of 7/1/23, but not go back to 6/30/23 and restate anything. That difference between the old methodology or model and the new methodology and model is going to be effective for your 7/1 balances. And so no adjustments needed for past periods. Everything is going to be opening net asset numbers, and then you'll have your recalculation at your current year end. When we look at the adoption of CECL, there's 5 different steps that we'll kind of talk through today. So we're going to look at, what is in scope. We're going to look at pooling those items that are in scope so that you can evaluate their losses based on the various characteristics of the pool. And then you're going to select a method for determining your losses and compute that, and then adjust that historical loss experience for the current and future considerations as well. So we'll start with step 1. That's going to be looking at what instrument types are within scope of the standard. So you can see here an excerpt. So we'll back up one. Yeah, see here an excerpt of the standard itself. This is outlining some of the items that would be applicable under the standard. So you can see things like financing receivables, receivables that are resulting from revenue transactions. That's going to be a differentiator than receivables that are not from revenue transactions. We'll talk about that in a moment. Another important consideration is around investments. So you can see at the bottom right of the slide, financial assets that are being measured at fair value, where you have the change in that earnings or the change in that value flowing through your statement of activities or your income statement. Those are not within scope of the standard. So they're captured at their fair value. They're not at that amortized cost, right? And so you don't have to look at those under the standard for any kind of allowance because they're captured already at fair value. These are going to apply to those financial assets that are measured at amortized costs or those investment in leases, things like that. But those that are at fair value, where you're recognizing that change through your statement of activities, are not within scope. Another item to look at, especially for nonprofit organizations, is going to relate to pledge receivables. So those are also not within scope of the standard. So the easiest way to kind of think through whether or not a receivable is going to apply is to think about the statement of activity impact of that receivable. So if you have a receivable that is related from an exchange transaction and that follows that 606 guidance, those are things that are going to generate receivables that are within scope of the CECL standard. If you have pledge receivables that are connected to contribution or support revenue, those are scoped out of the standard and they're not applicable. So you don't need to change your methodology as far as allowances for those. It's really going to apply to anything that's part of exchange revenue transactions. So looking at some common financial instruments, trade receivables, looking at maybe those from tuition, fees, or other services, those are within scope of the standard. The same with loan receivables or financial receivables, all fall within scope. And then also those investments in sales type or direct financing leases. So this is not the same as those operating lease, ready use assets. This is if you had the sales type or direct financing leases that you had that investment in it. So those would be within scope. Looking at step 2, so now that you've identified what assets that the organization has that would be applicable under the standard, now we want to group those assets into risk pools that have similar risks. So the standard requires that you group your assets based on your risk characteristics. What it gives leeway on is how are you going to pool those assets? So you can see on the slide some various ways that you may group your assets based on the risk of the organization. So, it could be based on the age of receivables. It could be whether or not they're collateralized, credit ratings of the customers, or location, things like that. All of those are ways to group your assets into similar risk pools. When it comes to pooling, though, it's important to understand that you can still consider certain balances to not be related enough to others so that you have to evaluate them individually. So a good example would be to think of your receivables. If you have a receivable with a customer that has gone into bankruptcy, that may have enough characteristics that it's not similar to your other receivables and should be evaluated individually. So just because you have these pools doesn't mean that every single receivable or every single asset is going to fall into one of these categories. There could be instances where you do have to individually evaluate different pieces. Then once we're at the point of pooling our financial assets, we'll be able to select a method for how you're going to evaluate or determine your potential loss rate. So the standard, similar to the pools, doesn't require a specific method to be used. It does give some examples, and really it's for the organization to decide what's the right method for you to evaluate this. And something to think about is kind of your data availability and reliability. And so looking at those, the information that you have in order to determine your losses will be a good kind of starting point to know which method is going to be the best method. So the two most common methods are here on the screen. That's your loss rate method and your aging method. The loss rate method is pretty much what it seems. It's looking at that historical loss rate for each of your pools that you have created. And you're getting to a final loss rate that you can kind of build off of for current and future considerations. The aging method is going to be looking at the age as it implies there. And it's going to be looking at, what sales and balances you had for those categories and the write-offs related to that. So it's a little bit more of an involved approach. The loss rate's really just looking at those losses incurred previously. The aging is going to kind of break it down a little bit further based on that aging analysis. And then you can see on the bottom, there are those other methods that could apply as well. So you don't have to use one of these two. These are just the more common approaches. And before we continue, Roselle, it does look like there was a couple questions. I'm not sure if we got those answered already or, perfect, you did. So
Yeah.
Go ahead.
But we could tell the entire group too. I think one of the participants had a question about grants receivable and whether they're in scope.
Yeah, so and you're exactly right in the response. That's where you want to think about how you guys have it recorded. So if it's something that is contribution or support, that's where it's not going to be within scope. If it's something that is an exchange transaction, then it would be within scope. So it's going to kind of depend how you're getting that grant and what you're doing for it and how it's classified in your financial statements. All right, so looking at step 4, that's where we're going to compute that historical loss experience in order to start the building of the loss rate that you'll use for your credit loss estimates. So you want to have that historical loss to be the starting point. And that's where you want to look at what data you have, the availability and accuracy of it, and kind of get that baseline rate that you can build the remaining credit loss estimate from. One thing to keep in mind is that the years that you're using for that analysis of that historical rate do not have to be sequential or the most recent. It's really what is the appropriate historical periods for your organization. So what that means is if we're looking at accounts receivable and we're looking at our loss rate over the last 5 years, for example, the organization may look at that and say 2020 was not an accurate representation of what our normal loss experience would be. And so you can eliminate 2020 from your analysis and only use the other years in your consideration. There may be other factors for why you eliminate, other years from consideration. It doesn't have to be sequential, like I said. It's just a matter of documenting those considerations and why you feel those years are not applicable when you're doing the calculations. The other thing to keep in mind is that you want to use at least 2 years of data when you're doing that analysis. And you don't want one of your years to be the year that's applicable. So if you're implementing it for 6/30/24, we wouldn't want to use this fiscal year or fiscal year 24 as one of your loss rate years, because that is what you're evaluating as what your potential loss is for that period. So you'd want to go into the past and look at past finished years and that historical loss data. So those are kind of the little nuances with that. There's a little bit more flexibility with the standard as far as what past years you use and why. And it's just really a matter of documentation when you're doing it. That leads us to our last step. So now we have our historical loss amount and we're going to adjust it for that current consideration and the future expectations as well. And so what the standard says, you can see here at the top, is that you cannot rely solely on past events. You do have to adjust that based on current conditions and then reasonable and supportable future forecasts. So we've got on the slide here some examples of how you would apply that. So when you're looking at your current conditions, a good thing to think about is what is different now in the current environment that wasn't applicable or wouldn't have been captured in your historical loss experience. And we'll talk through an example in a moment, but that's where you can kind of think about your customers and how they may have changed, or if there's factors affecting your organization with the environment, in whatever way that would mean. It could be economic, it could be political, whatever, that could change what that loss rate would be compared to what it used to be. And then when you're looking at those future considerations, that's where you have to have reasonable and supportable information. So a lot of entities are looking at that formalized forecast like GDP growth, unemployment, other considerations. And you can see on the bottom here, the estimates are reasonable for 1, 2, or 3 years. So we're not looking at a prolonged period of time. It's really just factoring in, those more recent considerations. So if we look at the example of an allowance and the components, this example kind of follows a university. And so we can see their historical loss rate for accounts receivable related to tuition. So that's an exchange revenue transaction. So those receivables are within scope. They've calculated out that they had a 4% historical loss rate. From there, we want to look at what are the current conditions that would have an effect on our loss rate that really probably weren't part of that previous historical consideration. So in this case, you can see they've opened a new nursing school. So it's hitting a new, subpopulation that they weren't previously working with. And so because of that, any of the tuition and fees related to that new program, they went ahead and added 1% to their previous calculation. So now we went from 4% to 5%. The final kind of consideration is going to be that future consideration. So we want to look at, is there any future risk that we would need to incorporate in our loss calculation? And so you can see here, they've added another 0.5% just because the nursing school is now drawing students from a different geography than they had previously. And they think because of that, there's a little bit of an added risk for that change that they don't have captured within their other loss rates. So that brings them to that new CECL estimate of 5.5%. So under that previous model, old GAAP, the incurred loss, we would have been at that 4% so long as it was probable, right? Now under the new model with the new GAAP, that's where we're looking at a rate of more like 5.5%, and it's going to be applied to all of the outstanding receivables. Another consideration, an area that we get a lot of questions around, is around programmatic loans. And they do have planned guidance coming out regarding programmatic loans. So be on the lookout for more formalized information on that. But looking at how to evaluate programmatic loans and the considerations around those payments. So it's going to vary based on the organization and the intent of them. But you can see on the first box here, if you always intended to fully forgive the loan, you're not within scope of the standard. So if you never intended to have any level of collections, then you don't need to estimate any kind of loss related to that because you're never intending to collect. So scoped out, similar to pledge receivables. If we go to that middle approach, where you always intended to partially forgive your programmatic loans, the portion that is not intended to be forgiven, so the portion you intend to collect, would be under the new CECL model and scope of the standard. The portion that you intended to forgive would follow the first box where you are scoped out of the standard. The final box here on the slide is, what if you never intended to forgive the loan, but now you have, or you plan to? Was the, is the loan scoped under CECL or is it out of scope? It's going to depend on whether the payment was probable prior to forgiveness. So if it was probable that you could have collected that loan previously, but now you have elected to forgive it, then you're outside the scope of ASU 2016-13, because you're not writing it off because you've incurred some kind of credit loss or that they are unable to pay on the loan. You're writing it off because you're choosing to do so. If the payment was not probable, then more likely than not, what you actually have is a credit loss. You're writing off that programmatic loan because you're unable, or payment was not probable to be collected previously. So it's all going to depend on what your intent was and whether or not forgiveness was always intended or partial, or if you were doing it because you couldn't collect. All right, so now you've implemented the standard, one and done, and you're finished, right? Not quite. With any standard, there's probably an annual consideration that you have to make. So you do have to look at this annually at a minimum. So at each reporting period, you do need to update your estimate of what that credit loss amount would be, and you would need to adjust your allowance accordingly. Any increases or decreases to the allowance would result in that credit loss expense. That's going to be similar to your bad debt expense previously. It's just using that new language with the new standard. Another common question we get is looking at, can the allowance be 0 under the new CECL standard? So they give an example within the guidance where expected non-payment is 0, and they use the US Treasury as an example of that case. Now, they specifically say that they don't intend it only to be the US Treasury. However, they list certain criteria that would have to be met to say non-payment is 0. And one of those is the ability to print currency. So essentially, the interpretive guidance of the standard has said that it would be very challenging to say that you would have a zero allowance if it wasn't from some sort of governmental entity that has the ability to print currency. However, you can see on the bottom, there are some instances where an allowance may be immaterial to an organization. And so that's where you may evaluate the standard and determine that a small allowance or immaterial allowance would be applicable. But I would say that, you can't just default to that. You've got to do the calculations, follow the standard changes. And then if you get to the point where you either don't record an allowance or you don't want to make changes to what you have recorded, that's a good time to kind of connect with your auditors if you're getting an audit done and, look at whether or not it's going to have a material impact to your financial statements for whether or not you decide to book an adjustment. But it's important to understand you do have to do the evaluation and the implementation of the standard in order to get to that point to make that kind of determination. So some key takeaways for topic 326 or ASC 326. Just know that, first off, it is not just for banks or financial institutions. That was a common misconception when the standard first came out. Your most likely items that you're going to be evaluating are going to be those trade and notes receivable, and you're going to use that historical loss. So you are still calculating that historical loss experience, but you're going to use that as your starting point. And from there, you're going to adjust for the current and future expected kind of impacts to that calculation.
I think the polling question is next, Amelia. We had another question if you want to.
Yeah, absolutely.
Okay. The question is, what if within 3 months you've received all of the receivables?
Yeah, that's a great question. So this is where you definitely need to work specifically with your auditors on that. If you can show that your receivables are very short-term in nature like that, you may be in an area where, you may not have to do a full analysis where you can prove out that collection has already happened. So any allowance would be clearly immaterial, right? The one thing you'll have to note is that you do need to show that those specific receivables were all fully collected. So there's probably going to be some kind of testing around those collections when it comes to evaluating that. But it is something that if you can show full collection in such a short amount of time, then you could have that argument that it may not be material to record an allowance. But I would highly suggest not defaulting to that answer and having that discussion, especially if you're having an audit done, because you need to kind of show that and evaluate that as well as part of the adoption.
Documentation is important.
Yes. All right, so we're at polling question 2 now, and that is looking at the adoption of the new law standard for institutions will be, and obviously you watch this course, so it's going to be easy, right? But easy, moderately difficult, or not material or not applicable.
Not material.
Oh, that's right, not material. So we'll give everybody a minute to get their answers in. Just a reminder, you need to be answering the polls in order to get your CPE credit. Hopefully nobody has difficulty. That would not be enjoyable. All right, so we're closing the poll out. All right, so 53% saying moderately difficult, which, it is completely understandable. It's got a lot of steps to it. I think once everybody gets into it, though, it should feel a lot easier and smoother. It seems cumbersome looking at all the words, but it's not too bad to implement.
All righty, let's see. So next we're going to move away from CECL and talk about some new guidance around crypto assets. So this is ASU 2023-08. So prior to this ASU, the ASCPA said that crypto assets were accounted for as an indefinite lived intangible assets. And they got a lot of feedback from stakeholders who raised some concerns about that being a little different treatment and didn't really faithfully represent the economics of the crypto assets. And that it also made it pretty difficult when you were going through and trying to calculate that impairment analysis. And so the FASB went back and revisited that and has come up with some new guidance. So in order to follow this new guidance, you need to make sure that your crypto assets meet the definition of intangible assets under the codification, that you do not receive the asset holder with enforceable rights or claims on underlying goods or services or other assets, that they're not created or reside on a distributed ledger based on blockchain or similar technology, that they're secured through cryptography, and that they're fungible. So this would exclude non-fungible tokens and also wrapped tokens, and also that they're not created or issued by the reporting entity or related parties. So depending on what type of entity you are, you may have some of these circumstances and therefore not be accounting for it as an intangible asset. But if you're pretty plain vanilla, you know, you have Bitcoin, that would fall under this category. Which is where most not-for-profits are. So under the new guidance, the way that you would account for this is, rather than accounting for it as an indefinite lived asset in which you would have to consider impairment implications each year, it'll now be accounted for at fair value. It's still classified as an intangible asset, but it's accounted for at fair value. So just like your investments, you're going to be recording the change in that asset in your statement of activities. The FASB does want it to be a separate line item on your statement of financial position. And they also want that change to be highlighted on a separate line item on your financial statements. You can classify it as operating or non-operating, just depending on how you're using those assets. So there is some guidance and gives you a little flexibility as far as whether or not you're going to classify it as operating or not operating on your statement of activities. And similar to your statement of cash flows, you have some flexibility as far as how you're accounting for it there as well. There are some pretty involved disclosures related to this. So first of all, you'll need to include a table that lists out the name, the cost basis, the fair value, and the number of units for each significant crypto asset that you hold. And then anything that's considered not significant can be shown as kind of an other and aggregated together. You're also going to need to disclose, just like you would with your net assets that are held at NAV, you're going to need to disclose some of the contractual sale restrictions for those particular assets that have those type of items, the duration of the restriction, and then circumstances that would cause the restriction to lapse. Again, a few more disclosures. So you would need to include a roll forward of those crypto assets. Pretty typical roll forward where you're going to disclose beginning balance and then any additions that you've had, any dispositions, and gains and losses. And they also want, and you can put this as a narrative below, kind of that roll forward, a description of the activities that resulted in the additions and the distributions. And then as far as dispositions of the crypto assets, you need to disclose differences in the sales price and the cost basis. And then, as I said, the activities and the reason for those dispositions. And then we did mention on the statement of activities, they want your gains and losses to be shown separately. And then also the other item to disclose is the method that you're using for determining the cost basis of the crypto asset. So just similar to inventory, you could use first in, first out, you could use average cost, you could use specific identification, but you need to disclose the method that you're using. As far as the transition approach, so this is effective for fiscal years beginning after December 15th, 2024, so calendar year 2025, or if you're a fiscal year, probably your fiscal year 2026. As far as transition approach, so this does require a cumulative effect adjustment to your opening balance sheet. So you would go back and look and see what was your cost basis as of the end of last year and what is the fair value as of 1/1/2025, and use that difference to be included as your cumulative effect adjustment at the beginning of the year. So that's it for crypto assets. I think that this really allows for some better reporting as far as crypto assets. So that leads us to our next polling question. We just thought it'd be interesting to see if anybody does hold, or I know a lot of not-for-profits accept crypto assets and quickly dispose of them, but just wondering if anybody holds the crypto assets.
It's nice these won't be intangible assets anymore. It'll just be,
It's
always seemed like an odd kind of placement for it.
It did, yeah, it did.
I'm curious how this comes out. I know a lot of organizations use those platforms to just convert it to cash automatically, rather than the risk of actually holding the assets, so.
Oh, the results are in. Okay. So most people are either in the no position or, so, as you're mulling through, or if your board starts asking about crypto assets, now you have a little background on how they would be accounted for.
And I don't think we've got any questions come in for it, Roselle, so
No,
I think we're good to switch over to the next topic.
All right. So next we're going to talk about the uniform guidance. You may have heard that there have been some revisions to the uniform guidance. So the Office of Management and Budget decided to make these revisions in the spirit of reducing the burden while promoting accountability and transparency. So the timeline for this, the first thing that they did was they launched the federal program inventory. And what this is a comprehensive searchable tool that allows users to better locate grants and opportunities for funds. And then on April 4th, 2024, they published their revised guidelines. On May 15th, 2024, all of the federal agencies had to submit their changes and their plan for implementing it. And then effective October 1st, 2024, these changes go into effect. So next, we're going to talk a little bit about what those changes are. So first of all, one of the items that they have done is made some changes to the allowable costs. I think that there had been a lot of discussion around data costs and evaluation costs, and the OMB decided to capture that and codify it into this guidance. So now you are specifically allowed to include data costs as an allowable cost. So when they went through and defined data costs, they said that this would be any expenditure to gather, store, track, manage, analyze, disaggregate, secure, share, publish, or otherwise use data to administer or improve the program, such as data systems, personnel, data dashboards, cybersecurity, and related items. I know that there are lots of entities that have these costs and will be pleased that that is now an allowable cost. The other one that they recognized, especially in this IT-rich environment, that really needs to be included and allowed are evaluation costs. So again, their definition of evaluation costs would be, would include evidence reviews, evaluation planning and feasibility assessments, conducting evaluations, sharing evaluation results, and other personnel and material costs related to effective building and use of evidence and evaluation of program design, administration, and improvement. So I think that's another great one that they have added in there, because I know that's something that a lot of people actually do have those costs associated. So now having it explicitly stated, I think helps a lot of entities out. The other one that they also made sure to specify is that costs related to closeout of those grants are now included. And then they also clarified the recipient's right to receive any remaining and available funds. So the next thing that they did was they increased various thresholds, and we'll go through these pretty quickly. So the first one, the one most people will probably get most excited about, is that they've increased the threshold for single audit from $750,000 of federal expenditures to $1 million of federal expenditures. So starting October 1st, if you have less than $1 million of federal expenditures, you do not need to have a single audit performed. So again, the goal was to reduce burden and create efficiencies. And so I think that was one of the things they really felt was important in order to achieve that goal. The second one is for subawards. So they've increased the threshold for requiring federal approval for subawards from $250,000 to $500,000. So if you have a subaward and you're going to give it to a recipient, it used to be that if it was more than $250,000, you had to get prior written approval from the federal agency. And now that requirement is no longer gone, and it's if you have 500,000 or more, you need that written approval. So again, another change. And these are effective October 1st, 2024. Same thing with equipment disposal. It used to be that if you were disposing of equipment and it was valued at $5,000 or more, you needed to get approval for that. And they've also increased that threshold to $10,000. Unused supplies. So you used to have to, if you had unused supplies greater than $5,000, you were required to sell those items. Now they've increased that threshold to 10. The other change that they've done is if you're using the de minimis amount as your indirect cost rate, they've increased that rate from 10% to 15%. And then the other change that they did is with your indirect cost calculation. It used to be that you're using subrecipient expenses and your indirect cost rate was capped at $25,000. Now they've increased that threshold to $50,000. So giving you an additional $25,000 to include in that. As far as the table, this is the table that goes through and that auditors use in order to determine what's considered a type A threshold, which kind of governs the programs that we're going to test. You can see here that they've increased it to $1 million. And then this threshold here has also been changed from 25,000 to 34 million. So a couple of little revisions when your auditors are going through and making that assessment. The rest of the items are all the same, but they did make that change just to comply with the $1 million threshold change. And then as far as other changes, a couple of other items that they've done. So they did remove the requirement to submit a D2 disclosure statement in support of your indirect cost rate every year. So if you go through and you have an approved indirect cost rate, it used to be that you would have to submit a disclosure of your cost accounting practices on an annual basis. They've now removed that requirement. And then there are quite a few items that required prior approval for certain costs, namely real estate, equipment, some meals and entertainment type costs, and they've removed that requirement for those items as well. And again, these changes are effective October 1st, 2024. So,
and just a pause there, Rosa. We do have a couple questions that have come in, a couple of them related to the effective date. So
okay.
Everybody can see that here, October 1st. There was an additional question that was looking at a calendar year entity that'll have $850,000 in federal funds So would they be required to have a single audit if that was for 2024? So that'd be looking at that effective date, of that 10/1. So if you're doing
Yeah.
a 12/31 audit, that's where you're gonna use those new thresholds.
Yes, correct. And I think that the reason they did that change is that if you were a 12/31/2023, your data collection form is due 9/30/2024. And so I think that they did those changes to coincide with kind of when that next calendar year data collection form would be allowed.
And I think that's all we've got.
I think that is, let me see. I think we have one more polling question. Oh, one thing, just a couple of keeps in mind and things to do, become familiar with the changes. One thing to think about is as you're going through and looking at your procurement policies, you'll want to comply those or with the new changes. And then, be sure to talk with your auditor if you have any questions about how this is going to impact your organization. So that brings us to polling question number 4. So do you think that the new uniform guidance is going to have a significant impact on your organization? These are pretty easy. Yes, maybe, no, or unsure.
Hopefully it has a good positive impact on everybody, raising those thresholds. Maybe some people won't have a single audit anymore. That'll be a great bonus for them.
All right, the poll is in. So most of y'all are at no. And it could be no because you're already well above the $1 million threshold. But hopefully, fingers crossed, it will have an impact on some organizations. So that concludes our presentation for today. We appreciate everyone attending and look forward to you attending our speaker series in the future.
Yes, Roselle, Amelia, thank you so much. I see the reactions, the hand claps, keep them coming for the group. It would not be a speaker series without ending on a joke. So I do have a joke for you ladies today. How do accountants manage to stay out of debt?
Oh, that's a tough one.
I was gonna say, I don't know. That is tough.
It's a little punny. I'll give you a hint. Let's see if anybody in our chat answers. Nope. Okay. They learn to act their wage.
That is funny for sure.
Look out, Matthew. You're going to rival him for those dad jokes now.
Yeah, I can't compete with his. Okay, so thank you so much. We did go ahead and drop the link for everybody in our chat if you needed to register for any future sessions. Also, if you caught some of the previous ones and you wanted to reference any of the recordings, we dropped that link in there for you as well. Thank you, ladies. Our next speaker series session will take place right after the 4th of July. It will be July 10th. At 1 o'clock Eastern on navigating the emerging trends of nonprofit leadership. We look forward to having everybody hopefully come back and hope everyone has a great rest of their week. Thank you, Roselle. Thank you, Amelia. We will talk to the group again soon.